In this learning capsule, we will understand the key emission scope under AASB S2. Let's break down emissions into three simple layers: Scope 1, Scope 2, and Scope 3. Think of them as ripples that start at core of your operations and move outward. Scope 1 is your inner circle, direct emissions from things your business owns or controls. This includes fuel burned in your delivery trucks, gas used in your factory boilers, or diesel generators running at your sites. If it burns, you control it, it's scope one. In accounting language, we call this our in-house carbon cost because it's fully under your control and you can act on it fast. Scope 2 steps one ring out. It covers the emission from electricity, steam, or heating you buy. You might not own the power plant, but you're using it, what it produces. Imagine the light in your office, powered by a coal-fired grid. That's scope 2. It's the stuff you plug into. And as energy prices and emission intensity vary, so does your scope 2 footprint. Switching to renewable electricity is one of the fastest way to cut scope 2 emissions. Now here's the big one, scope 3. This is a carbon shadow, the emissions you don't control directly but are still responsible for. It includes everything up and down your value chain. Your suppliers, the truck delivering your product, how customers use your product, and how it's disposed at the end of the life of the product. If scope 1 is what you burn, scope 2 is what you plug in, scope 3 is what the world burns on your behalf. It's the hardest to measure, but often the biggest slice of the pie. In fact, in most companies, scope 3 make up more than 70% of total emissions. So what's your takeaway? Start by estimating scope 1 and scope 2 using your existing bill and fuel data. And for scope 3, don't wait for perfection. Focus on your top suppliers or the biggest logistic flow. Even a simple estimate shows you're taking responsibility, and that builds trust with investors, boards, and regulators. When it comes to climate disclosure, Unilever is one of the world's most transparent companies and a real-world example of how to report emissions the right way. Let's start with the basics. Scope 1 includes emission from Unilever's factories, company vehicles, and refrigerated leaks. Scope 2 covers purchased electricity, and they break this down by country and by source. By source, it means highlighting how much is coming from renewables, how much is coming from non-renewables. Scope 3 is where Unilever stands out. They report emissions from the production of the raw material like palm oil, customer user products like detergents or shampoos, and even emissions from disposables, transport, and packaging. For example, Unilever calculated that two-thirds of their Scope 3 emission comes from how customers use their product, mostly from heating water to wash hair, clothes, or dishes. That level of insight helps them to design lower emission products. They don't stop there. Every year they publish a C at G emission data table and show how emissions per ton of products sold are changing. They are aiming for net zero by 2039, and they have tied climate performance to executive bonuses. Even when they fall behind on a target, they disclose why and how they plan to fix it. This is gold standard of climate reporting. What's the lesson for your business? You don't need to match Unilever overnight, but you can follow their example. Start by mapping what you know. Engage your suppliers and look beyond your walls. Because good climate reporting isn't about being perfect, it's about being credible, consistent, and committed. Now, this video should help you understand how emissions work in ASBS2. Stay tuned to learn more about the new sustainability reporting standard. Thank you.